Recipes for technical trading success in Cook's Kitchen.
Are we in a bear market right now? Very important question to answer, because if we are, you should be selling stocks and maybe even getting short. All right, I'm going to give you some facts and some charts and some other things, some data points you want to look at to answer that question whether we're not in a bear market. Before I do, let me preface it by saying in late December, I told my subscribers that the volatility was only going to get bigger in 2016. We'd gone sideways in 2015 with a couple of scares, but the range was going to get a lot bigger. I said the S&P would gravitate between 1,800 on the downside and 2,200 on the upside. That's right, I'm looking for new highs this year, but I felt strongly we'd make a trip down to 1,800. Well, we've basically done that already in January. And I said on the wide, 2 standard deviations, we could easily see the S&P go to 1,700 and maybe even 2,300 on the upside if the bull takes over again. All right, let's go to the charts and we'll discuss this. First thing I want to show you is the S&P equal weight. Now remember, an equal weight index gives equal proportion to each constituent. And the idea behind an equal weight chart is, hey, let's strip out the power of the mega caps, Apple, Google, and the energies that are still mega caps, and see what's moving the index. Because as you know, in December, an index like the QQQs was the strongest, seemingly leading the market, and those constituents also held up the S&P. Why? Because the FANG stocks, big cap tech, the overweighting there held up the indexes. So let's take a look at the S&P equal weight. This is a 3-year chart because I wanted to show you this green line going back to what we just did. The S&P equal weight already touched the February 2014 lows. The regular conventional S&P index has not gone that low yet. They've only touched the October 2014 lows. But let me draw your attention first to this, the rounding top we had in the S&P equal weight. And if we come out of the correction in the autumn, what do you have? The S&P equal weight in November and December not only making lower highs, can't get back up and make new highs. What's important here is, so you see the S&P equal weight. This is when the S&P was bumping up against its highs of 2,100, but the S&P equal weight couldn't do it, and then made a lower high in December and really started to roll over in late December. So this was your clue that breadth was waning. Now, there are dozens of different ways to look at breadth. You can look at the number of stocks above or below the 200-day moving average. You can look at how many new highs you're making versus new lows. Lots of different things. But the simplest thing to do is to look at the S&P equal weight. I've been saying this for years. This should be a chart you check at least once a month to see what's happening with breadth, because it's so simple. And it tells you what's the average stock doing in the S&P. So let's see what else I wanted to point out here. So breadth was already collapsing. The big caps were holding things up in the conventional index. And then here we go. Just falls out of bed in the first 2 weeks of January and touches this February 2014 low. Nice bounce. Speaking of volatility, look down here at the bottom pane, the MACD. Look at how wildly this is swinging already. 2015, 2014, nice steady climb in the index. The MACD is relatively tame except for that correction in the autumn of 2014. But now, just swinging wildly. After the autumn correction in 2015, now, big dip here, buyable opportunity. For my trading services, we wanted to be buyers at S&P 1820 on the first touch because conditions were deeply oversold. And here is my key measure of oversold and capitulation. Oh, lost that chart. There we go. This is the S&P 1500. I've shown this to you many times. The S&P 1500, obviously, the big cap 500 index, the mid cap 400, and the small cap 600, 1500 stocks. This is the high-low percent. It's a way of looking at new highs minus new lows. And when things get ugly, this thing dips deep into negative territory. I'm showing you a 4-year chart so we can go back to 2011. You can see what it did in 2011. When we had the correction in August, here we are in August 2015, we made this dip. I thought we'd get a double dip looking just like the 2011 correction, which was a 20% correction in the index. Other indexes were below a 20% correction, or beyond, I should say. And we didn't get that double dip right away. We got this, really fake big cap rally into November and December. I didn't think it was sustainable, but I had to get out of my short positions anyway. And here we come in, and now this correction has been so deep, it took the S&P 1500 high-low percent down to minus 34%, which almost matches this low in 2011 of minus 37%. Now, so that was a capitulation. We were looking for it in advance, and it helped us buy some lows below 1850 in the S&P. But it doesn't mean that this correction is over, and I don't think it's over, given the weight of fundamental evidence and technical evidence. We'll talk about some more of that. Let's go to the next chart. Here I have the conventional S&P 500 index, and it's just a daily chart, 3 years, so you got your 50 and 200-day moving averages, which have crossed bearish again. But what I want to point out is where fundamental buyers might come in. Now, so what I have lined up here, obviously I've drawn a line off of, just to mark the February 2014 lows, which was 1740 on the S&P 500. So if we start looking at earnings estimates coming down to 120 or lower, where is their value in this market? I've called this correction a valuation reset, and but not a bear market, because we don't have a recession. Now, history proves that you don't get, a true bear market without a recession. Maybe there's one or two instances you could talk about, but on the whole, large investors are not selling stocks in mass looking for, from 20% down, looking for 30 or 40% down, unless we're headed into recession. So right now, and the economic evidence doesn't stack up that way. Now, you can listen to a lot of different guys. You can listen to David Stockman, who says, we're headed for a big crash. Other folks who look at the economic data and see the glass as half empty are saying that we're already in a recession. But the data isn't there yet. So, and until it is, I'm not predicting a bear market. But the correction is going to get deeper. Let me show you why. So in this valuation reset, where will fundamental buyers really step in? They're not stepping in now. We're not getting a big V correction. Sure, we could, oil could rally, back up to $38 and, spark some kind of equity short covering rally, and maybe we get through the resistance at S&P 1975. Maybe we even go up and close this gap. Up here, there's a gap at S&P 2040. But I'm not counting on it in February. And so what I think is that fundamental buyers who believe there won't be a recession, this is what they're targeting. Give me something under 15 times. Now, it all depends on what the forward estimates are, right? David Kostin of Goldman Sachs was the man to listen to in 2015, because he took his earnings estimates for 2016 down really early in 2015 to $120, way below consensus. Coming into January, he was joined by a few other folks in taking their estimates even lower because of the oil bear. And, based on what falling oil, falling energy companies, failing energy companies possibly, we're going to do to S&P earnings, his new target is $117 in the index. I think there's risk for that number to go even lower. So let's say it goes down to 115, fundamental buyers, I think, will pay 15 times forward for $115. That's S&P 1725. But, what if things get really nasty and, everything's getting thrown out, the baby's getting thrown out with the bathwater? Maybe we could even see 14 times. And I think that's where you want to be a big buyer. Is anything below 1,700, you want to be a big buyer. So these are just guidelines where I think buyers will step in, because most fundamental fund managers are not predicting recession. They're just looking for better values. Anything else? Down here again on the MACD, you can see the wild swings here, just like on the S&P equal weight. So, that's the kind of volatility we're going to have. Deeply oversold here, but the buyers aren't stepping up with volume. Okay, let's look at the NYSE, another very weak index. It's the weakest broad market index. It's been leading the charge lower, so to speak, for basically all of 2015. Even though it made new highs in early 2015, it was falling apart early. And so this is a daily chart. It's already had a 20% correction. If you go from these highs of 11,250 down to about 8,900, that is a 20% correction. And it's nearly touched a 50% retracement of this whole move from the 2011 lows all the way to the 2015 highs. The 50% retracement comes in at about 8,800 on the NYSE, and we got to like 8,900. So, right there, it's bounced. It's bounced several hundred points. But again, big buyers are not coming in and turning this into some kind of V recovery because they see a ton of values. They're worried about energy. They're worried about lower earnings estimates. They're worried about the manufacturing numbers, which, ISM still below 50. You got the regionals, the Empire. The Dallas Fed comes in at minus 34, which is linked to energy. And you've got people like Larry Fink of BlackRock looking at the potential for 400 energy companies to fail. I assume he means bankruptcy. But that's a big number. So that is the shoe waiting to drop that a lot of fund managers are like, I'm not going to step in front of this until we see all these bankruptcies. This is something we've been talking about for a year. They're just not unfolding like you would think right now. So, maybe this could play out for another year. All right. Anything else on the NYSE chart I wanted to show you? I don't think so. We've talked about recession risk. I'm at a 25 to 30% chance of recession. Jeff Gundlach's at one chance in 33% odds of a recession. That's pretty high. He's not really a typical Wall Street fund manager. He's a bond guy, but he's looking at the equity market a lot, and he's looking at the economy, which matters more. So I think the consensus right now on Wall Street is probably a 10 to 15% chance of recession. As that number climbs, buyers back off again. All right, speaking of buyers, here's a guy I pay attention to a lot, Scott Minerd, Chief Investment Officer of Guggenheim. He oversees $240 billion, and these are some of his tweets after Davos last week. These are all on January 22nd, and he started to get really bearish last week. He said, the rally we're seeing last week was a dead cat bounce, and he called for S&P 1650. You can look him up on Twitter to see these. And this is a guy to listen to because, again, he's not a trader. He's running assets of $240 billion. And he's not a perma bear. He's not a Peter Schiff or Mark Faber or Bill Fleckenstein. He's a responsible asset manager for a big chunk of money. And before he came to Guggenheim, he was a bond fund manager in Europe, overseeing portfolios there. So he knows the credit markets. He also writes a weekly high yield letter. So you can go to Guggenheim and look him up. You can see his macro view letter and also his high yield letter. So he's looking at the energy market and what the potential downside is, especially in the high yield area. But notice his last tweet I have on here. He says, our credit work has found value in the beaten down high yield sector. So, and I also heard that from Western Asset. They manage about $450 billion, and I think they are credit managers. And they are starting to see values in high yield for distressed energy debt, companies that they believe will not go bankrupt, and the debt is very attractive because it's oversold, way oversold. All right, so tried to give you this picture here where I don't think we're in a bear market. Could stocks go lower and push the economy into recession and virtually guarantee a bear market? Sure, they could, but I don't think that's going to happen because I think that the majority of fundamental buyers are just looking for better valuations, waiting to see what happens with the energy bear market, and just biding their time, looking, for better values The Fed is not really that big of a worry because, even if they do raise a quarter point in March, that's not going to be the death blow for the high yield sector. Obviously, people are watching China too. Those gyrations, if we go back to any of these charts, I'll just go back to the S&P chart here. Which one? I want this one. When did trouble start? When China devalued their currency, when they dropped the peg in August, that was a big volatility event for markets. We weren't expecting it. Guess what? That story is going to keep playing out because China is trying to stair step this devaluation down, and I don't think it's really working for them. They're having to spend their foreign currency reserves just to keep it from collapsing. The market knows that the exchange rate is, dollar yuan is going to go higher, up to 7, possibly up to 8. So the question is, when will these bigger jumps down in the yuan come? Those will be credit event shocks for the market. So I think that's another thing that's keeping big fundamental buyers on the sidelines. That's why, you can try and play the bounces here, but I don't think this correction is over, and we're probably going to take out the lows near 1,800 on the S&P in February. So you want to have a plan for that before it happens, and then also know where you're going to be a buyer if the fundamental factors haven't changed that much. All right, so I hope I helped you answer the question, are we in a bear market, and what you're going to do about it for the next couple of months. I'm Kevin Cook. Thanks for joining me in the kitchen.